Hello friends, welcome to Sundaram Mutual Fund's monthly debt market update. The month of August was a good one for the Indian bond markets as the 10-year government benchmark bond yield closed lower by 13 basis points despite the fact that globally bond yields rose anywhere between 40 to 100 basis points during the month. This downtick in the Indian bond yields was largely on account of the benign crude oil prices and reports of Indian government bonds getting included into global bond indices. In terms of major events during the month, we had RBI monetary policy at the start of the month. The outcome of the monetary policy was largely in line with the market as the market was expecting a rate hike of anywhere between 35 to 50 basis point and RBI delivered a 50 basis point rate hike with some hawkish comments. The statement further read that due to the ongoing actions from the global central banks, the financial and economic conditions have deteriorated and the risk of a global economic slowdown has increased. Though the domestic economy remains resilient and inflation have also flattened, still it is at a quite a high level and beyond the RBI's comfort zone, and that needs some calibrated monetary policy action. This will also ensure the stable growth and also keep the inflation expectations anchored. Globally also, the statements from global central banks were not too different. The minutes of FOMC's July minutes were released during the month, and the most of the members of the committee were cautious about the continuing higher inflation and were pressing for the need to contain this and keep the monetary policy into the restrictive zone. Further, during the month at a global event, the Fed chairman delivered a short speech and again highlighted that still there is a need to forcefully bring down the demand to in line with the supply. And he also highlighted that he also highlighted the risk of prematurely loosening the monetary policy. This has led to the rise in the global bond yields, and it also shattered the market expectation of a rate cut sometime in the next year. In terms of macroeconomic releases, the CPI inflation printed at 6.71% compared to 7.01% in the previous month. It seems that inflation continues to flatten out post making its peak in the April this year. Going ahead, the inflation is expected to fall to 5 to 5.5% range by the end of current financial year. This expectation is aided by the recent fall in global commodity and food prices and improving supply chains. Though the sticky core inflation and volatile commodity prices on account of fast changing geopolitical equations remains a concern. However, the impending global slowdown, improving supply chains, and above average monsoon, these risks seem to be well balanced. In terms of growth, the GDP numbers for the first quarter of current financial year were released during the month. The print came a lot softer than the RBI's expectation of 16.5% and market expectation of 15.3, printed at 13.5. However, if we look at the high frequency data indicators and tax collections, we see a strong sequential demand within the economy, particularly coming from pent-up services demand. The tax collections for the first 4 months have been robust. The direct tax collections are higher by 35%, whereas the indirect tax collections are higher by 11%. This also reduces the risk of overshooting the fiscal deficit. We believe these higher tax collections should be able to cover up for the additional outflows on account of higher subsidies for fuel, food, and fertilizers, and to a certain extent should take care of lower receipts from divestments. Though any underperformance going ahead in terms of tax collections or additional outlays on account of food inflation can have some impact. However, the fact that The nominal GDP growth taken during the budget exercise was on the lower side. And taken at 11.1%, which seems to be on the lower side and can come to aid in terms of government meeting the fiscal deficit target for the current year. In terms of current account situation, though the situation doesn't seem as comfortable as in case of fiscal, as for the first 5 months itself, the external trade deficit has reached $125 billion compared to the $54 billion for the similar period during the previous year. This, however, should be taken with the fact that the recent rate actions by global central banks could result into global economic slowdown, which should also bring down the global commodity prices, which should have a benign impact on countries like India, which are net importers. At the same time, any geopolitical event leading into higher global commodity prices can have a negative impact on the already stretched current account deficit situation. The current account deficit for the current year is expected to be in the range of 3.2 to 3.5%, which is much higher than the long-term sustainable range of 2.5%. However, it is for now it seems well balanced by the fact that already the global commodity prices have started to cool off, and an impending recession should have a benign impact on these prices going ahead. However, this remains a concern for the rates market going ahead. We believe that markets are currently discounting a rate hike of anywhere between 75 to 100 basis point, whereas it seems from the current macroeconomic situation and commentary by governor, deputy governors, and also the minutes of MPC, that MPC believes that rates have already reached to a neutral level, as in the current repo rate is at 5.4%, and the inflation expectation for a year ahead are in the range of around 5 to 5.5% range. We believe that we may see a terminal repo rate of close to 6%, which means that market is largely discounting slightly higher than the rate hikes expected to be delivered by RBI. Also, the fact that short-term rates have risen quite sharply post the recent rate hikes by the RBI, which makes the short end of the rate curve pretty attractive for most of the investors. However, given the fact that any volatility into global currencies market on account of rate and liquidity actions by the global central banks and commodity prices can have a significant negative impact on the interest rates going ahead. Accordingly, investors should look to invest in products where the duration of the product matches with the investment horizon of the investors. Accordingly, investors having a very short investment horizon can look to invest in products like overnight and liquid products, whereas the investors looking to invest for anywhere between 1 month to 3 months can look for products like ultra short duration. Investors having investment horizon of anywhere between 6 to 9 months can look for products like low duration and money market product, whereas the investors having investment horizon of a year or more can look to invest in products like short duration and corporate bond funds. Similarly, investors having a longer term horizon of 2 to 3 years can look for products like banking PSU or medium term duration funds. With this, we'll wrap this update. Thank you for a patient listening. Stay safe, stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.